Hello, everyone. Greetings from the channel, Autodidact. We are back with Module 2 of the course, Stock Market for Beginners, a complete course to make from a naive to an expert. In the previous sessions we have learned about the various terms, which are essential to know before stock market investments. We learned about various types of shares and commodities traded in the stock market and its working, and how is intrinsic calculated. In the present module, we are gathered to formulate stocks buying strategies. We shall be analyzing the stock for buying or selling it. Friends, to begin with, it is worth mentioning here that stock analysis is a method for investors and traders to make buying and selling decisions. By studying and evaluating past and current data, investors and traders attempt to gain an edge in the markets by making informed decisions. There are two basic types of stock analysis. First, fundamental analysis. And second, technical analysis. Fundamental analysis is a method of evaluating the intrinsic value of an asset and analyzing the factors that could influence its price in the future. This form of analysis is based on external events and influences, as well as financial statements and industry trends. Fundamental analysis concentrates on data from sources, including financial records, economic reports, company assets, and market share. To conduct fundamental analysis on a public company or sector, investors and analysts typically analyze the metrics on a company's financial statements, balance sheet, income statement, cash flow statement, and footnotes. Also, the earnings report released by a company during its quarterly earnings press release is analyzed by investors who look to ascertain how much revenues, expenses, and profits a company made. Alright friends, now the food for thought is, what is checked in these financial documents? Let me tell you now. When running stock analysis on a company's financial statements, we need to analyze the company's profitability, liquidity, solvency, efficiency, growth trajectory, and leverage. For that purpose, different ratios can be used to determine how healthy a company is. For example, the current ratio and quick ratio are used to estimate whether a company will be able to pay its short-term liabilities with its available current assets. The formula for current ratio is calculated by dividing current assets by current liabilities, figures that can be gotten from the balance sheet. Although there is no such thing as an ideal current ratio, a ratio less than 1 could indicate to the stock analyst that the company is in poor financial health and may not be able to cover its short-term debt obligations when they come due. Looking at the balance sheet still, a stock analyst may want to know the current debt levels taken on by a company. In this case, a stock analyst may use the debt ratio, which is calculated by dividing total liabilities by total assets. A debt ratio above 1 typically means that a company has more debt than assets. In this case, if the company has a high degree of leverage, a stock analyst may conclude that a rise in interest rates may increase the company's probability of going into default. Stock analysis involves comparing a company's current financial statement to its financial statements in previous years to give an investor a sense of whether the company is growing, stable, or deteriorating. The financial statement of the company can also be compared to that of one or more other companies within the same industry. A stock analyst may be looking to compare the operating profit margin of two competing companies by looking at their income statements. The operating profit margin is a metric that shows how much revenue is left after operating expenses have been paid and what proportion of revenue is left to cover non-operating costs and is calculated as operating income divided by revenue. A company with an operating margin of 0.30 will be looked on more favorably than one with a margin of 0.03. A 0.30 operating margin means that for every dollar of revenue, a company has 30 cents left after operating costs have been covered. In other words, the company uses 70 cents out of every dollar in net sales to pay for its variable or operating costs. In a nutshell, fundamental analysis includes a variety of measurements such as price, earnings to growth ratio, return on equity and dividend yield, to name a few. An important aspect of individual stock analysis will be the company's growth potential over the next few years. Ideally, investors want to own a stock with a high growth potential because it will be more likely to lead to a high stock price. As we know, there are various tools and techniques that can be used for fundamental analysis, but they have been categorized into two types of fundamental analysis: top-down analysis and bottom-up analysis. Let's proceed to the process of doing top-down analysis. Top-down analysis takes a broader view of the economy, starting with the entire market before narrowing down into a sector, industry and finally a specific company. This method allows investors to analyze the market from the big picture all the way down to individual stocks. Because the top-down approach begins at the top, the first step is to determine the world economy's health. This is done by analyzing not only the developed countries but also emerging countries. A quick way to determine an economy's health is to look at gross domestic product (GDP) growth over the past few years and the estimates going forward. Often, the emerging market countries will have the best growth numbers when compared with their mature counterparts. Unfortunately, because we live at a time in which war and geopolitical tensions are heightened, we must be mindful of what is currently affecting each region of the world. A few regions and countries throughout the world will fall off the radar immediately and will no longer be included in the remainder of the analysis due to the amount of financial instability that could wreak havoc on any investments. After determining which regions present a high reward-to-risk ratio, the next step is to use charts and technical analysis. By looking at a long-term chart of the specific country's stock index, we can determine whether the corresponding stock market is in an uptrend and worth analyzing, or is in a downtrend, which would not be an appropriate place to put our money at this time. You can visualize in the chart. The blue line shows the price movement over a period of time. It has a lot of ups and downs. The red line is the overall trend that shows the overall uptrend or the downtrend. These first two steps can help you discover the countries that would match your wants and needs for diversification. The third step is to do a more in-depth analysis of the country's economy and stock market's health. By examining the economic numbers such as interest rates, inflation, and employment, we can determine the current market strength and have a better idea of what the future holds. There is often a divergence between the story the economic numbers tell and the trend of the stock market indexes. The final step in macro analysis is to analyze the market indexes such as the Sensex and Nifty. Both fundamental and technical analysis can be used as barometers to determine the health of the indices. The market's fundamentals can be determined by such ratios as price to earnings, price to sales, and dividend yields. Comparing the numbers to past readings can help determine whether the market level is historically overbought or oversold. Technical analysis will help ascertain where the market is in relation to the long-term cycle. Use charts showing the past several decades and zone down the time horizon to a daily view. For example, indicators such as the 50-day and 200-day moving averages help us find the current market trend and whether it is appropriate for investors to be invested heavily in equities. So far, our process has taken a macro approach to the market and has helped us determine our asset allocation. If, after the first few steps, we find that the results are bullish, there is a good chance a majority of the investment worthy assets will be from the equities market. On the other hand, if the outlook is bleak, the allocation will shift its focus from equities to more conservative investments such as fixed income and money markets. Deciding on asset allocation is only half the battle. The next integral step will help investors determine which sectors to focus on when searching for specific investments such as stocks and exchange-traded funds, analyzing the pros and cons of specific sectors, that is healthcare, technology, and mining. It will narrow the search even further. The process of analyzing the sectors involves tactics used in the prior approach, such as fundamental and technical analysis. In addition to these tools, investors must consider the long-term prospects of the specific sectors. For example, the problem of depleting natural resources and their increased prices for petrol and diesel over the decades, the reasons for the emergence of electric vehicles in the society. The situation like COVID-19 will act as a catalyst to increased automobile demand, as people will prefer traveling independently instead of public transport. Conversely, the increasing demand for energy coupled with higher prices is another long-term theme that could benefit the alternative energy and oil and gas sectors. After the entire amount of information is processed, a number of sectors should rise to the top and offer investors the best opportunities. However, if an investor feels the added risk of selecting and buying an individual stock is worth the extra reward, there is an additional step in the process. This final phase of the top-down approach can often be the most intensive because it involves analyzing individual stocks from a number of perspectives. The second approach, that is bottom-up approach, is the opposite of top-down investing, which is a strategy that first considers macroeconomic factors when making an investment decision. Top-down investors instead look at the broad performance of the economy and then seek industries that are performing well, investing in the best opportunities within that industry. Conversely, making sound decisions based on a bottom-up investing strategy entails picking a company and giving it a thorough review prior to investing. This includes becoming familiar with the company's public research reports. Most of the time, bottom-up investing does not stop at the individual firm level, although that is the dimension where analysis begins and where the most weight is given. Industry group, economic sector, market and macroeconomic factors are brought into the overall analysis in turn, but starting from the bottom and working your way up in scale. To illustrate this, let me call my friend Lucifer.
Bottom-up investing focuses on individual stocks. It's the opposite of top-down investing, which emphasizes the economy and market trends. An investor using the bottom-up approach analyzes a specific company, assuming an individual company can perform well even in a struggling industry. Bottom-up investors find a company that interests them and then examine its products, management, and financial health. They also study how its stock has performed, but overall market trends won't influence bottom-up investors as much as recent product enhancements. To succeed, bottom-up investors need a good idea of what to look for in a stock's performance. Not all investors have the time to thoroughly review a company's offerings, or the ability to grasp what it all means. A combination of bottom-up and top-down investing is what usually works best for investors.
I believe now you have understood it better. Bottom-up investors are usually those who employ long-term, buy-and-hold strategies that rely strongly on fundamental analysis. This is due to the fact that a bottom-up approach to investing gives an investor a deep understanding of a single company and its stock, providing insight into an investment's long-term growth potential. Top-down investors, on the other hand, can be more opportunistic in their investment strategy and may seek to enter and exit positions quickly to make profits off short-term market movements. Bottom-up investors can be most successful when they invest in a company they actively use and know about from the ground level. Companies such as Facebook, Google and Tesla are all good examples of this idea, because each has a well-known consumer product that can be used every day. When an investor looks at a company from the bottom-up perspective, he first inherently understands its value from the perspective of relevance to consumers in the real world. Moving ahead to the last part of the analysis. The pros and cons of fundamental analysis. Fundamental analysis helps traders and investors to gather the right information to make rational decisions about what position to take. By basing these decisions on financial data, there is limited room for personal biases. Rather than establishing entry and exit points, fundamental analysis seeks to understand the value of an asset, so that traders can take a much longer-term view of the market. Once the trader has determined a numerical value for the asset, they can compare it to the current market price to assess whether the asset is over or undervalued. The aim is to then profit from the market correction. Other benefits include diversification among not only top sectors, but also the leading foreign markets. This results in a portfolio that is diversified within the top investment-worthy sectors and regions. This type of investing is referred to in some small circles as conversification, a mixture between concentration and diversification. The top-down approach may sound foolproof. However, investors must consider a few other factors. We can call them cons of fundamental analysis. First and foremost, there is the possibility your research will be incorrect, causing you to miss out on an opportunity. For example, if the top-down approach indicates the market is set to continue lower in the near future, it may result in a lesser exposure to equities. However, if your analysis is wrong and the market rallies, the portfolio will be underexposed to the market and will miss out on the rally gains. It requires multiple areas of analysis which can make the process extremely complicated. It is also important to consider the best and the worst case scenario. While fundamental analysis provides a more well-rounded view of the market, it is possible for negative economic, political or legislative changes to surprise markets. For example, another downfall to the system occurs when sectors are eliminated from the analysis. As a result, all stocks in the sector are not included as possible investments. The leader in the sector is overlooked due to this process and will never make its way into the portfolio. Finally, investors could miss out on bargain stocks when the market is near lows. Alright friends, this is all about fundamental analysis. But the key is to practice it. A reasonable time spent to learn it can enable you to ace the market. If you have any doubts for something to be included in the video, please mention in the comment section. Keep learning with us by subscribing the channel. Good luck.